Hey everybody, good to be here today. It is Friday. That means it's the time for advanced option strategies. Today I want to talk to you about making options trades that make sense for your portfolio. And so I'll get into that in a lot more detail in just a minute, but probably doesn't make sense to do bullish trades if you're more bearish, or bearish if you're more bullish, if you're trying to reduce your increase your theta in your portfolio. To do negative theta trades. And that's just an example. We're going to talk about that and coming up here in just a minute. See some familiar names in the chat. Glad you're here. Also joining the chat is Connie Hill, helping me out. So Connie, between Connie and myself, we'll do our best to answer your questions. I appreciate Connie. I've been working with Connie for many years, over a couple decades now. So she knows her stuff. Make sure you check out her various webcasts, including her trading ETFs webcast on Mondays. That one is not recorded, so you got to make sure you check that out live. You can also follow Connie and myself on X at Brentmore CS, at Connie Hill CS. Today we're talking about options. Options do carry a high level of risk and are not suitable for all investors. The information today is for general informational purposes only. It's not an individual recommendation, or is it it's not a recommendation of any particular securities, chart patterns, or investment strategies. The paper money software application is for educational purposes only. It's a great tool, but it is for educational purposes only, a great way to practice. And for the sake of simplicity, I'm likely to not include commissions or fees in a lot of these trades, in any sample trades we do, but just realize they do exist. All investing involves risk, including the potential risk of loss. And let's see, what else? All investing involves risk, including loss of principal. Rolling strategies, I'm not sure we're going to do any today, but they can entail additional transaction costs. And short options can be assigned early. They're going to be assigned anytime up to expiration, regardless of the in-the-money amount. And there's no guarantee a stop loss is going to execute at or near the activation price. Okay, all right, there we go. Let's head on over to the Thinkorswim platform, folks. Let me try that one more time. There we go. This is the S&P 500. Trend keeps on going up. Bullish trend. If you're a trend trader, then and you decide, hey, I'm going to try and continue to ride this trend, you may consider doing more bullish strategies. If you think maybe the trend is about to break, then maybe you consider doing some more protective strategies in your portfolio. But one way to do this is to start out by beta weighting a portfolio. And before we beta weight our portfolio here, I want to go through a couple concepts. One is just the concept of beta. Beta is a measure of how much of stock or option or portfolio or whatever moves in relationship to the S&P 500. Well, I have the S&P 500 up right now, but you could actually bring up a study on the graph. Let me just get rid of this. And let me pull up, there's beta, which goes back 5 years on Thinkorswim. There's also something called fast beta, which goes back a year. And I'm just going to throw that on the chart. And this is comparing it to the S&P 500. Now, technically, you can change it to something other than the S&P 500. Fair enough. But the standard that people use, when you just say beta without specifying anything else, people are talking about the S&P 500 generally. Okay, so ignore the little drop off there. I'm not sure why that's why, because this is a future date. I have an expansion on the graph and it's going to today. What's my beta showing? My beta is showing 1 because this is the S&P 500. S&P 500 is moving exactly in proportion to the S&P 500. But if I look at other stocks, let me just go, we'll say Dow stocks. Here's Verizon. I can see that what the beta has been on Verizon over time. Or Coca-Cola. I can see what it's been. How does this move in relationship to the S&P 500? A beta of 1 means this stock statistically historically, no guarantee the future, has gone up. Basically, if the S&P 500 is going up about 1%, Home Depot, which is the stock I have up right here, is going up about 1%. If S&P 500 is going down about 1%, then Home Depot or whatever stock you're looking at is going down about the same amount. Now you can look at other stocks, other companies. Let's pull up NVIDIA. Here's NVIDIA, and you can see the scale is very different. And you can see it was very high, 3s, 2s, certainly above 1 for almost pretty much the whole time. What does that mean? It means when the market's going well, market being the S&P 500, this is actually tends to be outperforming the market, going up even more. And if the market goes down, this tends to go down even more than the S&P 500. All right? So that's what beta is. It's just measuring the movement of a company against the S&P 500. Okay? Or you can, sometimes you can see an index and measure it that way. But that's what I wanted to say on beta. You can look at beta there. You can also go to the trade tab, look up, you got to just expand this out, and it has beta. Here I have fast beta. You can change that setting to the longer term beta if you want if you go to the gear and go to application settings, and I think it's under calculation, maybe display. It's under one of these. It has, it asks whether you want beta or, oh yeah, right there. I was missing it right in front of my eyes. Okay. So if you wanted to change that setting there. Okay. So I usually look at fast beta because I think that goes back long enough to give us the time that we need on that. Okay. So that's the first concept. Before we get to beta weighting a portfolio, in other words, assessing the bullishness or bearishness of your portfolio, of your overall portfolio, what I'm going to do is I wanted to define beta. Now let's talk about delta for a sec. If I look at a portfolio and I just have all my positions ungrouped here, and if you have your positions grouped and you want to ungroup them, you can just click on the gear up here and it says show groups. I just uncheck that, okay? And you can see here's a delta. So I have deltas. AVGO, I have a delta of 100. This tells me how much money I'm likely to make or lose approximately given a $1 move in the underlying stock. In this case, I have Broadcom AVGO. I have 100 shares of stock. The stock goes up $1. I'm going to make about $100 in the portfolio because I have 100 shares. Bank of New York Mellon. I have 100 shares. My delta is 100 because I have 100 shares of stock. If you just have stock positions, the delta is just going to equal the number of shares of stock. But some of these other trades, you'll notice the deltas aren't quite even here. Adobe, I have a negative 78 beta. That means if if Adobe goes up $1, I'm going to lose approximately, again, it's an estimation, $78 in this portfolio. Why? Well, because it's some sort of, I don't know what Adobe is. What do we have? We have a long put on Adobe. That's why. Okay. So when you're dealing with options, this can tell you how bullish or bearish they are. If they're positive, it's a bullish trade. If it's negative, it's a bearish trade. This was a long put, hence the negative sign. It's a bearish trade. There are all other trades you can look at. Let's look at Caterpillar. What do we have on Caterpillar here? I've got a long call and 81 delta. Okay, so there you go. So you guys can go through that and see. So that's the two first introductory concepts I wanted to talk about, beta and delta. Now, how does this come together into beta weighting? The problem is if I'm trying to assess the risk of the portfolio, AMD going up $1 is very different than Adobe going up $1, which is different than Bank of America going, or Boeing going up $1 or whatever. Okay. So is there something that we can do and say, what if the market goes up $1? How much are each of these positions going to be affected? By market, I'm going to call that the S&P 500. Okay, but you can change that. If the market goes up a point or $1 or whatever you want to do, how much is my portfolio going to be affected? Well, this position is going to go up approximately 7.8. This is going to go down approximately $80 worth. I can look at the sum at the bottom of the page right there. I can look at that sum. Let me just do this so I can keep my time. So there's my delta. Let me just expand that a little bit. So 1,050, okay? But that doesn't really make much sense. I need to beta weight. I need to say the portfolio. So I'm going to beta weight, click beta weight, click on SPX. And now it tells me if the market or the SPX, now I could do NDX or something like that, if the market goes up a point, then I'm making about $38 on this. Well, how much is the SPX? How much is the point on the SPX? The point on the SPX isn't much, okay? The SPX is approximately, sorry, my marker is not working very well. We'll try that again. Approximately $6,400. Okay, that's supposed to be 00, $6,400. That would mean a 1% move, which is substantial but nothing earth-shattering, is about a $64 move. So if I take that $64 move for a 1% move and multiply that by my portfolio's delta, I'm going to take my calculator here. I'm going to take 64 and multiply it by 38. I come up with about a $2,400 impact on my portfolio. Now, this is a positive delta. So if the market goes up about 1%, then I would expect to make approximately, I already forgot the number, I shouldn't have erased that, 64 times 38, approximately $2,400. Okay. If the market goes down, say 3%, I would take that $2,400, multiply it by 3. I end up with like $7,200 loss on that. Are you comfortable in your portfolio if you do that? Obviously, your numbers are going to be different in your portfolio. How big a loss should we consider? Well, I don't know. You can run through different models here. If we pull up the SPX, let's just look at the S&P 500 here, and let me just go to a plain chart, and let me go back, let's go back 10 years here for a sec, okay? We're going to go back 10 years. I'll just put weekly data, click on OK, and we had some good times and some bad times. I'm going to zoom in just since about 2019 because we had a few events during that time frame. And I can go here and I say, well, how big of a pullback is it? How big a pullback did we have? Well, let's see, okay? I'm just going to do this. This was COVID, by the way. Let me try this again. It was about a 35% pullback with COVID, okay? 35% pullback in COVID. Well, you're going, well, COVID's COVID. That's an unusual thing. It is an unusual thing. But look, unknown things, uncertain things happen in the markets all the time. We don't know about that. Here was a pullback. This was 2022, not COVID. It was still kind of a big pullback. How big was that? That was about 26% pullback, approximately 26% pullback, okay? What about earlier this year? What did we have earlier this year? We had something in the order of a 20%, 21% pullback or something on the SPX. And I can tell you on each of these, if you looked at the NASDAQ, I'm not going to take the time to do it, but if you looked at the NASDAQ, the pullback would be even greater. But we're talking about the SPX right now. Okay. Now, let's go back here. So if we're trying to consider the risk in your portfolio, this is, you may want to do a little math here on this. And the math isn't complex. I'm going to go through, I'll go through another example. Now, Greg says, my delta is NA. Usually if your delta is NA, I've seen this before in mine, one of the positions along the way, if you look at each of your positions, usually there's an NA in there, Greg. And so it can't sum up all the positions if one of them has an NA in there. okay? And so you either have to group it in a different group, that's kind of a workaround, and then you can look at the rest of your positions combined there, okay? Or you can do a little, if your portfolio is not too big, you can add them up yourself, I guess. But that's what that happens. I've seen that before. Okay, so let's say, what if our portfolio, let's talk about a 10% pullback, okay? 10% pullback in this particular portfolio. We said the SPX is about 6,400. So that'd be about 640 points on the SPX. If I multiply that times my portfolio's delta, obviously your portfolio will be different, times 38, I'm coming up with about approximately a $24,000 drop in the value. Now, let's be fair. 10% is a very big drop. And likely we'll try to take some measures to try and help things out. Number one. Number two, delta aren't static. Deltas change. So the first percent drop has a delta of about 38, okay? Or the first point drop, I should say, has a delta. But as the market drops more, that delta can change, okay? Each of the positions can change their deltas too. So this isn't an absolute number, but it's, I think, a decent guideline on giving you just a sense for risk in your portfolio and how bullish you are. If you're comfortable with that risk in your portfolio. And if you're not, you may want to, maybe you want to up your delta. Maybe you want to decrease your delta. Let's talk about ways of doing that. We're going to do that next. Now, Kelly said, hey, yes, can we do a similar thing in the analyzed? Yes, we can. I'm not going to do that right now, Kelly, just for time's sake. But yes, we can. You can look at your portfolio, your whole portfolio here in the Analyze tab. And if you go to Risk Profile, you can go down here where it says single symbol and change that to portfolio beta weighted. If you're going to do that, make sure you have SPX up there. Okay, but I'm not going to do that right now. Okay, so let's go forward to our next thing here. All right. And that is, if you're looking at your portfolio, you'll see, I have a delta column, and that's what I've been talking about so far. We've beta weighted this, okay? But we also have a theta column where I can see my portfolio's theta. And probably most traders like to see positive time decay. Okay, and when are you going to get positive time decay? Well, short options will give you positive time decay. And long options will give you negative theta. Okay, so let's say you add a long call in here or a long put. Well, my theta is going to go down. Or if it's negative, it's going to go down further to a bigger negative number. Similarly, we can look at the vega, or the sensitivity of your portfolio to implied volatility moves. Right now, it's around 241. So that means if implied volatilities increase by 1%, then my portfolio is likely to change by about $240. Okay, so that is so those are kind of the biggies that we're going to talk about there. All right. Now, let me get rid of this. It's not going to, I wanted to expand this column, but it's not. There we go. Yeah, $242 there on that. I just want to make sure there wasn't an extra decimal point on there I was missing. Now, Theta Vega, Chris asked about Gamma. Thank you very much, Connie, for helping Chris out there. Gamma, does that move up or down? Was Chris's question. It's a good question. Kind of depends on the trade. If you have a long call, Gamma goes up as the delta goes up. Okay. And short call, no. So it's opposite. Just depends on the trade. Okay. Let's go and let's talk about adjusting. So what kind of trades would we do to adjust? Well, any type of trades, as we think of types of trades, think about how it's going to affect primarily probably your delta. That's going to be usually the biggest impact on your portfolio, but also your theta and your vega. So let's just think of a few, and this isn't necessarily going to be a comprehensive list, but let's take, just for example, a long call, okay? A long call, positive or negative delta. It's going to be positive delta. In fact, a long call is not only going to be positive delta, it's going to be quite positive. It can add pretty significant positive delta there. Let's take, say, a short put vertical, okay? A short put vertical, positive or negative delta. That's going to be positive delta as well, but it's going to be usually, it kind of depends on the strike prices you choose, but typically it's going to be a much smaller impact on my portfolio than if I do a long call there. What about, so this is going to, let me just put a D here for delta. What if we talk about theta? What's a long call going to do for theta? Well, it's going to give me negative theta, negative time decay on there. What about short put vertical? Theta, well, if it's out of the money, it'll give us positive theta. Okay, vega, positive for a long call, negative for a short put vertical, assuming it's out of the money. And you can go through a lot of different trades like this. A long put, how's a long put going to differ? Well, our delta would be negative, significantly negative. Our theta is going to be the same. Our vega is going to be the same. So long call, long put are going to be the same in terms of theta and vega, but my delta will be different, okay? And a short call vertical, short call vertical, negative delta, right? Theta, positive, it's out of the money, vega, negative. So you just got to think about the trades that you're doing here on this. So let's look at a couple. And I'm going to look at a couple that are, you can consider what trades you do by what you want from your portfolio. So for example, let's say I'm looking at my portfolio and going, I'm kind of bullish here. I'm a little bit worried maybe that I want to maybe, the market's maybe seeming a little frothy. I don't want a bearish portfolio. I don't want to flip my whole portfolio to a negative delta. But what I do want to do is I want to maybe lessen the delta a little bit. I want to put in something with a negative delta on the trade. But at the same time, I don't necessarily want to put in something that's going to affect my theta that much. Because if I'm thinking negative delta, the first thing that kind of comes to my mind is long put. But one of the consequences of that negative delta is it's negative theta too. And I'd like to maintain my positive theta in my portfolio. So what if we do like a synthetic? Okay, should we look at a synthetic here? I'm going to do that. And so I'm going to look at a stock that I'm going to consider to be more of a bearish trend here. And that's Dow. Okay, this isn't Dow Jones Industrial Average. This is the stock Dow. Okay, so here's the thing. I'm going to show you a short synthetic. Okay, now this is a short synthetic. This is going to add a lot of negative delta. It doesn't have much in the way of impacts of theta or vega. It's also a type of trade that a lot of people aren't going to be approved for. Are there other bearish trades we could add to a portfolio? Sure, you could do a long put. This is an advanced options class, so usually we try and do multi-leg option strategies in this class. So I'm not going to demonstrate just a long put here. But, and I also kind of want to demonstrate a new kind of trade that we don't do as often, but just realize a lot of you are not going to be approved to do a short synthetic here. Now, so how do you do it? What you do is, first of all, you pick an expiration date. And that's one difference between synthetic and buying a stock or even shorting a stock. is you have an expiration date on these. That's a difference there on this. Also, remember, options there's no dividends on options. So if you're buying a stock, let's say you were buying a stock, you'd be getting about a 6.5% dividend yield on Dow right now. It's a pretty high dividend yield. But if you did a long synthetic, you wouldn't be entitled to that dividend. And if you do a short synthetic, you're not going to have to pay it there. But just realize there are differences between synthetics and stocks. Okay. But if I'm going to do that, I'm going to decide on my expiration date. And here I'm just going to go to 19th of September. This is a monthly option, by the way. And I can go here. If I go to the weekly options, one thing you may notice is sometimes, depends on the trade, sometimes your liquidity is not going to be as good. Your bid-ask spread may be pretty substantial here. I'm not really seeing that on Dow right now, but just realize that's something to consider on that. So what I'm going to do is I'm going to go at the money. Well, at the money. What's at the money? At the money is the strike price that's closest to the current stock price. We're kind of like almost smack dab in the middle between our available strikes. So if we're right at the money, typically a synthetic is going to be zero upfront cost or very little credit on that, okay? But we can't go exactly, there's no 21.25 strike price here. We got 20 or we've got 22.50. I'm just going to go to the 22.50. I'm going to click on the ask price to buy a call. I'm going to go to that same strike price, 22.50. I think I said call, I meant put, buy a put. I'm going to go to that same strike price and I'm going to sell a call. I'm going to hold down my control key. And this is a short synthetic. Let me just kind of demonstrate what this looks like to you. Let me analyze this trade. Here we go. This is what it looks like. Notice the more the stock goes down, this is the stock price down here. The more that stock goes down, the more the profit I get on that, okay? The more the stock goes up, the more of a loss I get on this. So this may make sense if I want to add a negative delta to my portfolio, okay? If I want to add negative delta. But let's do this. And Mike, let me address your question here in just a sec, okay, in terms of the expense on this, because it may surprise you a little bit. Here's the current price of the stock. Look at my delta on this. Negative 97 delta, almost negative 100 delta. Remember, if I'm shorting 100 shares of stock, my delta would be minus 100. This is pretty similar in regards to delta. We already talked some of the differences between this and shorting the stock. But in terms of the delta, at least, this is pretty similar to shorting 100 shares of stock. Look at my theta, though. Look at my Vega. Those are very small numbers, 0.32. My Vega, 0.04. Because the call and the put largely offset each other. This has very few theta impacts to my portfolio. Very few Vega impacts to my portfolio as well. So when I look at this trade, what's the cost of this trade? Expand this out just a little bit so you can see. About $140, about $140. Okay, $140. In the grand scheme of things, that's not a massive debit. Now, you need a margin account to do it. It's an advanced options trade. Practice on paper money before you do it for real. But let's consider adding this to my portfolio, because when I do this, if I do this trade, let me go back here. This is going to impact the overall delta on my portfolio. My delta right now is about 38, we'll say 20, okay? 38.20. It's moving around a little bit, okay? So let me go here Now, I can also say, look, the challenge of this trade is if the stock goes up, I'm losing money, okay? So I'm going to put an exit on this. I'm going to say, look, if we go above, say, our recent bounce here, that low, I'm going to call that kind of a resistance level. If we start to break above that, I'll say, that's a little bit above 24. If I break above 25, I'm just going to exit this trade and try and cut our losses out. So I can do that as well. I can go here. I can create an opposite order in order to get out of this trade. And I'm just going to make this a market good till canceled. I clicked on the wrong thing somehow. Market GTC. I'm going to click on my gear. And I'm going to say, if the stock goes above, I think we said 25, marks greater than or equal to $25, we're going to cut bait here. Now, does that mean we're going to get out exactly when the stock's at 25? It doesn't. Dow could easily gap up or something like that on here. But that's the trade. Let me just kind of see, make sure I can get that in. I'm going to confirm and send. And we're going to add this. I don't have anything grouped. I don't have the choice here on this anyway. I'm going to throw that trade in. Okay. So let's go and let's look at our portfolio. We just added this Dow. And beta weighted about negative 37 delta. So we reduced it a little bit from 38, 38.10 or something down to about 37.71. Not the largest impact, but it does go to the point of we're adding negative delta there. Okay. Now, I saw there was a question in the chat. It's like a calendar. Remember, calendars, it's going to be 2 calls or it's going to be 2 puts. This is a call and a put. Okay. Call and a put. So additionally, though, if we look at this, it's giving us a little theta impact, not a huge theta impact, but it's there, and very minimal vega impact there. So consider that when you're doing your trades considering your trades there. Now, let's say you're looking at this and going, this is not enough of an impact. Are there other more impactful securities you use? You could do index options. Could you do options on the SPX? Yeah, you can. I'm not going to do it today, but if you do options on the SPX, it's going to have very likely a very, very significant impact on your delta. Okay. In fact, perhaps too much of an impact on your delta, depending on what you do. Okay. But if I did that short synthetic using the SPX, then we wouldn't be talking about a minus 0.37 impact on that delta be significant. Now, a lot of people will look at this, and I've taught on this before in webcasts. Often, instead of using the SPX, we'll use an index product called the XSP, which is 1/10 of the impact of the SPX. That would probably have more impact than what this Dow is going to have on my portfolio, but it's not going to have near as much as the SPX. So go ahead and play around with that. All right? Play around with that. So so you got to just decide how much impact you want to have on your portfolio. In general, for our purposes, we're going to stick with an overall bullish portfolio here. Okay. Now, let's take a different tact here with another trade. Let's say I don't really want to impact my delta that much, but I'm going, this theta is, I kind of want to maybe boost up. We've just taken a small hit to my theta with Dow. I want to impact my theta there on this. And, my vega is kind of high. I wouldn't mind reducing that a little bit. Well, let's think about this. There are neutral trades you can do out there. For example, you can do a calendar spread. Somebody's mentioned a calendar spread. You can do an iron condor, okay? Those are both neutral trades, okay? Those are both neutral trades. Sort of neutral. They're not exactly neutral. It depends on what the strike prices are that we choose, but they have different impact. They're both positive theta. They both are going to help me on that theta front. But a calendar is a positive vega trade. An iron condor is a negative vega trade. Okay, and there we go. Okay, so let's do an iron condor here. Let's see if we can do something to perhaps chip away a little bit at the vega and increase a little bit, at least, my theta, and not probably impact my delta that much. So in this case, what I'm going to do is I'm going to look at more of a neutral type trade. And of course, you can go scroll through, and for these examples, you're going, Brent, how did you find these examples? I just scrolled through a list of liquid options. I scrolled through, I think I have, S&P 100 stocks that are trading at least 10 million shares or something like that on average a day, something to that effect, okay? So, but S&P 100 stocks is a decent place to start often in terms of finding liquidity. And so I just scrolled through, and if I identified, is it trending down? Well, Dow was trending down. Most of the stocks were trending up. Not a shocker. The SPX is trending up, okay? XSP, Scott, not SXP, XSP. That does have options, XSP. So I may have written it down wrong. I apologize if I did, if I put that in the wrong order. There, XSP. Okay, but here's one that I saw, oh, this one is kind of going more neutral-ish. All right, so I'm calling AT&T, and I'm going to say this is a little bit more of a neutral type trade here, okay? So I'm going to go to trade. I'm going to go, well, I'll stick out about this, this same date, okay, about 42 days. You can go out more or less there. And I'm going to go out, and I'm going to go a delta roughly 20. Well, we don't have anything 20, but I'm going to go here. So I'm going to look to sell my 30 strike, and I'm going to look to buy. I'm just holding down my control key, my 31 strike. That's a short call vertical, but I'm going to make this an iron condor. Again, I'm going to go out. This is a little bit of a higher delta here, but I'm going to do this. I'm going to sell this control just because I want to bring in enough credit on this. And I'm going to hold down my control key and buy this. And that's a short put vertical. Put together the short call vertical and the short put vertical. And what do we have? We have something wrong here. Let me just look. Something does not look right on this. 3031. Oh, you see that? I accidentally double clicked. And so that's looking a little better. That 7-cent credit wasn't looking quite right there on that. So let me just right click on this and let's analyze this trade. This is an iron condor. That's an iron condor, all right. Let's look at the current price. Here's the current price. Delta, not much impact on terms of delta. Theta, positive theta. Vega, negative vega. And there you go. Let me go back here. Let me just double check. I'm just going to jot down 3770, 394. I'm just copying down the delta, the theta, and the vega here, and 242. Let's enter this trade. I'm not going to put a stop on this trade. It's a limited, unlike the short synthetic, which has really high theoretical risk. This is a spread where we are limiting the risk substantially. Let me go over here and just see if we can put this in, and I'm going to put in more than, come on. I'm going to do 5 contracts because this is such a low price stock here, an option. Okay, you can confirm and send, and we're going to send that. Come on, Phil. Okay, I'm going to just push this, and because I want to get this filled, because I want to, there we go. I want to look at our overall impacts there. So monitor, let's go back down here. Okay, delta was 3770, still 3770. Theta was 394. I've upped that with that iron condor there, okay? And Vega, I've lowered it about 10 points. It was 242 to 232. So here's the bottom line, okay? Bottom line is, consider your overall portfolio needs. Delta, Theta, Vega. If you'd like, you can beta weight the portfolio. I showed you how to do that today. Then, when you're considering stocks, or options trades, consider them from the underlying stock itself, but also considering how it fits into your overall portfolio. I think that is a sensible way of doing things. Okay, all right. I'm going to call it there, everybody. But let me just mention a couple things. One, coming up at the top of the hour, we have market movers. I'm going to be teaching that today, so that's in about 20 minutes, market movers. Connie Hill, thank you for helping me out in the chat. Thank you for those questions, for those answers to people's questions. Always appreciate Connie. She's very helpful with that. Thank each of you for joining me today. And I hope that I see you at market movers here coming up, but if not, have a wonderful weekend ahead, everyone. And we'll see you all same time next week. Bye-bye.